Howdy, hot shots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. Here to tell you about the problem with locking in a price with ULTY puts. Okay, so I did a video called the waterfall method. I'm sure other people have used it before. That's what I'm calling it. That's what I use, where I set limit orders in a stair step down, increasing in the amount of shares that I purchase at each lower price. And somebody said, why don't you lock in your price by utilizing puts, which is a great way to lock in a price and a great way to generate some extra premium. So I am not bashing on selling ULTY puts. Now, last time I looked, the premium wasn't all that high on it, presumably because it had been a relatively stable fund, and at least for a little while, so the implied volatility on it was down. And in addition to that, people don't want to generate put income as much as they want to generate yield off of the fund. Okay, but here's the big problem with counting on a put to lock in your price. And that's if you sell a put below the price of the ETF at this point in time, it could dip down below your strike price. Okay, we all know that that can happen. That would be the benefit of locking in your price, right? Let's say the fund was trading at $6.15 and you sold a $6 strike put, a cash covered put. Well, if at closing the fund is below that price, is below the $6 strike price, then those shares would get put to you. Okay, you would wind up paying $6 per share, $600 for 100 shares, which is, so per contract, you'd be buying 100 shares. You would keep the premium that you made by selling the put. So not only did you get a $6 share, cheaper than the $6.15 when you sold the put, you also, the cost basis is reduced by the amount of premium that you received for selling the put. Great plan, great idea, right? I do this all the time with stocks. I look at a stock and I go, well, you know, it's been on a run for a few days. I want to buy some shares. I want to get in on the run, but I want to do it after a pullback. If it runs away from me, no big deal. So I sell a put. This guarantees that if I do wind up buying the stock, I buy it at a lower price than what it's currently trading at. And then I also receive additional premium, which reduces my cost basis and gives me a cushion for the price to go down even more before I'm losing money. Love this. Okay, I've been selling cash covered puts in order to make my entries into stocks for years. Another thing that you can do is that you sell at a strike price above the current price of the shares. So you sell an in the money put. Okay, what this will do is it will allow you to participate in some of the upside of the shares, in addition to receiving the premium, which could reduce your cost basis on the shares immediately. I've done this a lot too. If there's a stock that's going up quickly and I want to buy it, but I still want to get a little better price than there is in the market right then, I'll sell an in the money put. Okay, say the stock is trading at $65. I may go sell a $70 put, and then I generate, let's call it $8 worth of premium on that share. So I'm actually paying $62 for the shares if they get put to me at $70. So I can make $3 right away compared to buying the stock. I can get a $3 discount right away. If the shares go above $70, they won't get put to me and I'll keep the whole $8 premium. Okay. If they do get put to me, then my cost basis is reduced by the $8 that I received in premium. Okay. You can do this with ULTY. You could go sell an in the money put and get a little bit of a discount on the shares right away. Now you're not going to be getting the distribution while you're waiting for that option to expire. Okay, so that's a big drawback. If you are selling an out of the money put, meaning that you sold one at a strike price lower than what the shares are trading at right now. I had used the examples that I wanted to buy shares at $5.95 and $5.90 and $5.85 or something in that range. I can't even remember exactly what I put the limit orders in for. They're sitting there in my account. I'm probably going to be buying ULTY before I even wake up in the morning. Okay, I hope I am. Right, last I think the shares were trading at around 603. If in the morning tomorrow it gets pushed down a little bit, goes down to 595, boom, dividend daddy locked in some shares at 595 strike. If it keeps going down, I lock in more shares at a 590 strike, okay? Whatever the prices were, they were a few cents off per, and I think I started out with maybe a 50 share order and then upped it to a 75 share order at the lower strike price, at the lower limit price, and then 100 shares at an even lower limit price, so that I have this waterfall method set up to dollar cost average on the way down, grab me the highest yield possible. So on the surface, it looks like this is the same plan. Sell a $6 put, okay? And then when they get put to you at $6, then you've locked in a $6 price and you've also got the premium. The problem with that method is it can happen, but it probably will not happen. It's unlikely that your contract will be exercised prior to expiration date. So if the shares are trading at $6.03 right now, you turn around and sell a $6 put, okay? The shares dip down to $5.95. That put is now in the money. It's in the money by a nickel, okay? That doesn't mean that somebody's going to exercise the option. They're still sitting on the intrinsic time value of the option. So if they were to exercise the option in order to capture that nickel, they would be giving up all of the time value that they have left in the option. So the closer you get to expiration date, the more likely it will be that it will be exercised prior to expiration. But it still doesn't happen to me very often. Okay, it has happened, but it doesn't happen very often. So if the shares dip down to $5.95 and then prior to expiration, they have moved back up to $6.05 or $6.10 or any price $6 or above, your option will not be exercised. Okay, so you are not locking in a lower price. You're not locking in a lower price in the same way that you are if you set a limit order, it hits that price target and boom, your limit order is executed and you now own those shares. You get to ride them back up from $5.95 to $6.05 or $6.15 or whatever it is, okay? So you haven't actually purchased the shares by selling a put. So that is if you want to own the shares and you want them at a specific price, that is the drawback to selling a put in order to, quote, lock in a lower price on the shares. It may not get exercised. It may not be in the money at expiration, even though it dipped down to the price that you wanted to buy the shares at prior to expiration date. So that's why I have those waterfall limit orders in instead of just selling a put. Now, I do sell puts, and I plan on selling puts on ULTY. I have a couple different things that I plan on doing, and I'll be going over all of them with you guys, whether you like them or not, or you can come on here and tell me I'm an idiot or tell me it's a waste of time or I'm going to lose money. Like a lot of people are here telling me I'm going to lose all my money on ULTY. Well, I don't have all my money invested in ULTY, so, that's irrelevant. It's actually a relatively small position size compared to my overall portfolio. And I think that that's how any investment should be, right? I do see some people going all in on ULTY, and I'm jealous because if it works out, holy moly, it's going to be a home run. But I don't have the brass cojones to do that, okay? I don't want to lose everything that I've been working for all these years. I don't want to lose all the opportunity that I have should something go wrong, okay? And I think that's how we should all look at it. My first priority is capital preservation, okay? My second priority is growth and income, all right? Now, maybe that will change over the years. I still do take these investments that are more volatile, but I don't want it all in one of them, okay? That's why I have probably 20 of these different covered call funds. I also have individual stocks. I also have regular indexed ETFs. So I do not put all of my money in any one investment, but I am jealous when I see somebody do it and hit it big because, it's like winning the lottery. If you were to put all of your money in ULTY and it does continue to perform the way that it's been performing the last few months, oh my gosh, it really is like hitting the lottery. Okay, but I do buy lottery tickets occasionally just for fun so that I can have hopes and dreams. I can look at my ticket and imagine, what if, but I don't count on winning because it's not likely. And that's why I don't put all my money in one fund, because I look at this fund and I go, man, it's really awesome. What if it continues to grow? Okay, but I'm still skeptical. I'm a cynic because of everything that's happened over the last 43 years. And so I don't put all of my money in ULTY, but I am accumulating shares. I'm going to continue to accumulate shares. I'm dripping all my dividends back into the fund. And so I'm accumulating shares that way. And, as I get more comfortable, I'll be putting more and more money probably in there. If it continues to go up a little bit, if my cost basis gets so low on my existing shares that I'm like, okay, it's not easy for it to go below what I've got invested yet, I'll be more comfortable adding larger chunks of money to it, right? If I buy it at $6.45 and then I wind up with $2 worth of distributions, and now I go, oh, it has to go below $4.45 before I'm actually losing any money, that money is a lot safer in my mind at that point because I've already reduced my cost basis to the point where I have a huge cushion. And now I'm going to be comfortable doubling down on the position because I'm only risking the same amount that I was willing to risk in the first place, right? In my own opinion. You all have to trade and invest in your own style. You don't let anybody else tell you what you should be comfortable with, okay? But I did want to get on here and address that situation with the puts. Puts are a great tool to use in your investing methods. But in this particular case, I want to lock in my price at the lower prices. I don't want to wait and see if I get them. So that's the difference there. And I've done a lot of cash covered puts. I've done some naked puts. I've done a lot of covered calls and some naked calls and some debit spreads and credit spreads. And, I will say there's a lot of you out there that are watching these videos that are very sophisticated investors. Okay, you know more than I do. You've done more than I've done, and you've made a lot more money than I have. But there's also a lot of people watching the videos that probably don't even fully understand what a covered call is, and here they are buying into a covered call fund. So I will be doing a video just to do a quick breakdown of different types of options and what they mean for those of us who maybe haven't had as much exposure to them in the past or don't even really know what an option is or what kind of strategies can be used when dealing with options. So anyway, I'll talk to you later.